Time for the word on Wall Street. Top investors watching your money this morning. Joining me right now, Woltech Capital Markets Chief Strategist Kathryn Rooney Vera. Moving on to that question, Kathryn, and Art mentioned this, the Consumer Price Index for May coming out this Friday. The expectation is for a year-over-year increase of 8.3%. That's right in line with the number that we had in April. What are you expecting here, and how are you allocating your money? What would you own in this environment? What would you sell in this environment?
So inflation is both sticky and structural, meaning it's going to stay high for an extended period of time. Staying high means it's going to be double the target. The target is 2%. I think by year end, inflation is going to end at about 4.7%. And that's simply because of statistical base effects. Last year, inflation started taking off. So the denominator, the base of comparison, is higher, meaning that the headline number is going to get lower by year end. You know, I agree with Mike's sectors. Those are the sectors I've come into the year saying that we need to be overweight, and those are a de facto rotation from cyclicals to value. We got to get defensive. Recession is inevitable. And I think that the only thing that allows the Fed to pivot, as Mike mentioned, are bearish factors, and they're threefold. One is a labor market deterioration. We've seen a red hot labor market, but if it gets bad, if unemployment shoots up, the Fed's got to lay off the brakes. Credit spreads blowing out. That could take equities even lower. That puts the Fed on hold in terms of both quantitative tightening and rate hikes. And the third one would be the tightening in financial conditions that we've already seen year to date. The Fed's only hiked rates 75 basis points, yet we've seen the 30-year mortgage rate about 5.5%. We've seen consumer loans get more expensive, and the loan spectrum in general. So that in itself, Dagan, could take economic activity slower. So I think that the Fed has very little room to even do anything. There is no longer the Fed put. That's over. The best thing that we can hope for is that the Fed does not roll off assets to the tune of $95 billion per month, which is their plan right now. And the other thing that the best thing that we can hope for is the Fed doesn't hike what the market is expecting, which is in total 250 basis points for this year. But inflation is sticky, it's high, the labor market is hot, it could roll over. And these are the concerns that I think we need to be thinking about. We need to be rolling out of the sectors that get killed in stagflation, which is the base case scenario that I have for this year, and recession, which are discretionary, which are tech. You know, there could be tactical plays short term in terms of a month or two. But for structural portfolios, Dagan, we need to get more defensive. We need to have precious metals. We need to have cash, and we need to get defensive.
And that was the question everybody was asking me. And these are just working Americans who I was talking to for the last week, is they just want to know where to put money in this kind of environment that doesn't get eaten up by inflation, but also doesn't put they don't have a lot of downside risk. And I think you hit some of those areas, certainly. Kathryn Rooney Vera, thank you so much. Incredible insight always.